good evening, team. Welcome to you all in today's webinar on White Oak PMS offering. We have Mr. Vivek Singh Gupta from White Oak Management to discuss about India Pioneer Portfolio Management Service. Before I request to Mr. Vivek to take charge and introduce us to White Oak Capital Management and its offering, I would like to take a few minutes to to introduce him in brief. So, Mr. Vivek Singh Gupta heads sales at White Oak Capital Management. And he is having around 16 years of experience in the financial service industry. Prior to joining White Oak Capital, he was co-head of sales and distribution at Goldman Sachs Asset Management India, responsible for institutional clients and private banks. He started his career with Benchmark Asset Management, pioneer in quantitative and passive asset management. So we all know Benchmark because they have introduced ETF or passive management in India. So Mr. Vivek, over to you. So probably would request you to introduce us first White Oak Capital Management to our team, and probably then we can move on to the product.
Certainly. Thank you so much, Ritu, and good afternoon, everybody. Thank you for taking the time today. So maybe as Ritu mentioned, I would probably start off by giving a background about ourselves, about White Oak, what we have done, where we are, and what our plans are. And then as a segue, speak about our past track record since the last 4.5 years that have been around, and then spend some time on the investment philosophy process, portfolio construction, and how we are basically positioning the portfolio at this point of time. So I'll just share my screen. Ritu, is it visible to you? Yeah, okay, great. So White Oak was set up in June 2017 by Prashant Khemka. So we're coming up to 5 years of existence. Today, as we speak, we manage close to 45,000 crores of AUM. All of this is invested in Indian equities, listed Indian equities. And bulk or majority of this AUM is from offshore investors. So close to 76% are from foreign investors investing in Indian equities, and about 25% is from domestic investors in our PMS or AIF strategies. And if you look at the bottom right-hand side pie chart, it will show the investor mix. So of the total AUM, 40% is from institutional investors. Now, these are large FIIs in the form of sovereign wealth funds or pension plans who've invested with us to take exposure to Indian equities. About 45% is from individual investors or their family offices in our PMS AIF or any of our offshore strategies. And the rest of the investors are a mix of charitable foundations, endowments such as US universities, etc., who also invested with us to take India exposure. So you will notice one unique thing at White Oak is the AUM is largely at this point of time from offshore investors. It's quite the opposite from India dedicated managers, where you will have bulk of the AUM from domestic investors and some of it from offshore. The reason for such a split is basically with Prashant's background. So Prashant, before starting White Oak, was with Goldman Sachs Asset Management for 17 years in various leadership positions. Prashant began his career of investing with a company called State Street Global Advisors in Boston 98. Moved to Goldman Sachs in 2000, initially as part of the US growth equities team. Initially, he managed or invested monies in markets such as US, Europe, and Japan. In fact, he became the co-chair of the investment committee and a senior portfolio manager of the US growth equities team by 2004, which till date is the fastest acceleration of anyone from the role of a junior member to that of a coach of the investment committee. But Prashant always wanted to invest in Indian equities, and 2006 decided to come back to India to help set up the Goldman Sachs Asset Management Division in Mumbai. He put together a team and launched the India Equity Strategy in 2007, which he was the fund manager and CIO for 10 years from 2007 to 2017. Now, that particular fund was amongst the best performing India equity funds over that time period. And as a result, the AUM, which was zero in 2007, grew to $2.5 billion the day he left Goldman to start White Oak. And the performance of the multi-cap space is one of the reasons why we've been able to attract the kind of AUM that we have managed to raise even here at White Oak, because the past performance has been very strong, which I'll speak to you about in a minute or two. And along the way, in addition to the India responsibility, in 2013, Prashant was asked to become the fund manager and CIO for the global emerging market strategy. Now, this was an existing strategy which Goldman Sachs used to run, but did not have very good performance. He took that over in 2013, turned it around to top 1 percentile, and even there, the AUM grew quite significantly from $600 million in 2013 to 2.6 billion in 2017 when he left Goldman to set up White Oak. So Prashant, over the last 25 odd years, has invested across markets, developed emerging markets, and of course India, and has interacted and with a lot of clients, global clients who invested with us here at White Oak. But domestically also, we've grown quite rapidly. We are currently, if you look at domestic AUM, it's about 12,000 crores in our PMS or AIF strategies. And this comes from about 5,000 to 6,000 investors from, so it's very granular even in India, where we've been able to raise AUM not only from a few large families, but also from a large portion of the HNI investment community. So all of this money that we have of 40 or 1,000 crores is invested basically in a multi-cap strategy. We have different fund vehicles to basically get money from different geographies, but they all broadly follow the same philosophy of investing across sectors, across market caps in a multi-cap strategy. The White Oak India Pioneers Equity Portfolio PMS was launched in 2019, which is again a multi-cap product. The underlying investments are mix of large cap, mid cap, and small cap, and investments are across sectors. We don't have any theme or any style in investing. We believe that the best way to invest is to do a bottom-up stock selection process. So our energies are focuses on identifying businesses and building the portfolio where we find the best ideas and the most attractive valuations. So as a segue to that, maybe I'll spend some time on the past track record before talking to you about what is our invest philosophy and how do we approach investing, what is the process, what is the valuation framework that we have here at White Oak. So the past performance, what I'm going to show you is the performance of the first fund here at White Oak, what we call as the India Econ Fund. Now the PMS, which we launched in 2019, pretty much has the same portfolio, but this has a slightly longer track record. So I'll show the longer track record first, then I'll also show you the PMS track record. So we launched White Oak on 1st of 2017. This is still 31st December 2021. You'll see performance of the fund is 25.2% annualized versus BSE 500 of 14.8% annualized for an alpha or outperformance of 10.4%. So very strong outperformance over 10% alpha, which when compared to the peer group in the multi-cap space, it would be amongst the top 1 percentile of managers. And you will see in every single calendar year, be it 2017, 2018, 19, 20 or 21, there has been alpha which has been generated. So as an example, in 17, 11.4% alpha, 18, 19, where the alpha was less, it has to be kept keeping in mind the context of that year, where mid and small caps had the worst performances ever versus large caps in 2019. So in those 2 years, the fund was by far amongst the best performing strategies. And of course, 2020, which was the COVID year, with the market very volatile, even that year, the performance is very strong with a 20% outperformance. So the alpha is very strong, but also very consistent. So it's not as if there has been 1 or 2 quarters where the fund has done well, and there have been quite a few quarters the fund has not performed. So very often clients ask us what has been the performance in different market environments, in up markets and down markets. So what this will show you is that the performance has been consistent in both up and down markets. So first of all, on an overall basis, there have been 18 calendar quarters since we started in 2017. 13 out of 18 quarters, the fund has outperformed the benchmark at an average of 2.06% per quarter, or about the 9% per year mark. Out of the 18 quarters, there have been 12 quarters which the market was positive. 8 out of 12, the fund has outperformed the market at an average of, again, close to 2% per quarter, or about 9% per year mark. And there have been 6 quarters in which the market was actually negative. 5 out of 6, the fund has fallen less than the market at an average of 2.3% per quarter, or close to 10% annualized outperformance. So what is evident is that the performance is consistent in both up and down markets. And that is thanks to us having a very balanced portfolio at any given point of time, which is a good mix of pro-cyclical and counter-cyclical names. So we don't have any style bias or any factor bias. We try and maintain a good balance in the portfolio so that the performance is both strong and consistent in different market environments. If we further drill down the performance to understand how the performance has been when we look at from a market cap standpoint, and then from a sectoral standpoint. Now, when it comes to past performance, one aspect is to see what is the absolute return of the fund. Has the fund delivered 13, 15, 25% returns? And then obviously measure that with the what the benchmark has written, because return. So performance is to measure relative to the benchmark or the peer group. So in that case, as you saw on the first slide, the alpha has been 10%. But that only gives you half the picture. What is very important also to understand what is the source of alpha. Did the alpha or the performance come because of the stock picking ability of the team, or did it come because of the team getting just lucky from an allocation standpoint? So what does that mean? So sometimes, let's say you have invested in 2013. 2013 to 2015 or 2016 were very good years for mid and small caps. Most mid and small cap managed it very well, simply because that segment of the market did very well. But in 2018, when there was a large correction in mid and small caps, managers who had strong stock selection outperformed the managers who did not have good stocks, because a lot of stocks fell, but a lot of stocks did not fall or fell less than the broader market. So the skill of a manager is to identify stocks which can outperform in any given market, whether markets are positive, negative, or that particular market cap is doing well on. And that is repeatable because stock selection is regarded as skill-based. Allocation effect is just an outcome of the stock selection, which over periods of time would be close to a zero-sum game. What it basically means is, let's say the next 6 months we're overweight large caps and large cap does well, so we will benefit from having a high allocation large caps. And let's say the next following 6 months mid and small caps do well and we are underweight, again we'll be hurt because we have an underweight position in in mid and small caps. But what we strongly believe, sitting today, it is impossible to tell whether large, mid or small will do better relative to each other. It's only known in hindsight. So, which is why all our focus on stock selection, and we don't worry about the allocation. We believe allocation is just the outcome. So with that as the background, if you further look at this slide or the numbers, I'll kind of walk you through some numbers. Overall, over the 4 years that the fund has been in existence, the fund has returned 191% gross of fees and taxes versus benchmark of 80%. So the alpha is 109.5. Of this, stock selection has contributed 143, whereas allocation effect is actually a minus 34% headwind. That's because over this time period, we had an overweight position in small caps, and small caps haven't done as well as large caps or mid cap, which is why that has hurt our performance from an allocation standpoint. But stock selection has been very strong in every single market cap bucket. You look at in small cap itself, the index small caps has returned 26%, whereas the stock selected by the team has generated 236.9% return. So very strong alpha in small caps. In mid caps, 400% for the portfolio, 78% for the mid cap index. And in large caps, 153% for the portfolio, 90% for the index. So in every single market cap category, be it large caps, mid caps, or small caps, very strong alpha, and all of that has come from stock selection, which is something which is skill based, and hence you can have confidence that it can repeat in the future. The same analysis, when viewed from a sectoral basis, will again show you the same picture. Now, what we strongly believe at White Oak is fundamentally all sectors are fairly valued. So we assume that be it financials or energy or utilities or consumer are fairly valued. What we're looking for is ideas within each sector which are available or at a discount to its intrinsic or fair value. So we never assume that a particular sector is bad or a particular sector is looking good. We assume all sectors are fairly valued and we look for opportunities. Now we could find stocks which can come from a sector which is regarded as which is going through a tough phase, like for example in 2017 pharmaceuticals or the pharma sector was considered to be quite a challenging sector because there were a lot of US FDA related issues at that point of time. Now our view is that don't write off a sector, look for ideas which can make money or can generate alpha to the portfolio. And we ended up investing in certain pharma companies which did not have or had very little of the total revenues from the US, whereas they were largely dependent on domestic consumption or let's say emerging markets like Russia. So we keep a very open approach and we don't have any top-down view on a particular sector, which is why you see that we have investments across sectors, and in each and every sector there is strong stock selection linked outperformance or alpha, which again, my earlier point is something which is skill based and repeatable. So to summarize the past performance with three key takeaways. Number one, over the last 4 years, the fund has returned 25% versus benchmark of 15, so about 10% alpha. Second is very consistent performance, not only in magnitude, but also in the number of quarters in which it did better than the market. And this includes both up and down markets. And third, the performance has come from stock selection rather than taking a view on a particular market cap, particular segment of the sector of the market. And that is something which is considered as skill-based and hence repeatable. And if you combine White Oak's performance with Prashant's performance Goldman Sachs for the last 15 years, then the performance would be very similar, where the alpha is about 9%. So market has given 10% over the last 15 years, plus 9% alpha for a returns of nearly 19 to 20% for the portfolio. So that is the past performance and our background. Maybe to kind of now speak to you about what we believe or what we think are the reasons for generating the kind of performance the team is able to generate, and more importantly, the consistent performance the team is able to generate. That we believe is having a very focused investment culture at the firm, what we call as a performance first culture, where very simply put, the aim of the team is to generate returns for investors relative to the benchmark and to the peer group. So the idea is to generate top 1% performance versus the peer group or versus the benchmark. And this culture is based on 4 pillars of philosophy, team, process, and portfolio construction. And all these 4 pillars are aligned with one another. So they're not in isolation, but have to go hand in hand with one another. The philosophy is to buy businesses and not bet on any macro factors. To go with that, we have a team of stock pickers implementing a time-tested, disciplined, fundamental research process, core of which is a proprietary OpCo-FinCo valuation framework, where we focus a lot on cash flows and not on P multiples. And finally, like I already mentioned earlier, the idea is to have a very balanced portfolio so that you can outperform in different market environments. And the aim of the team is to ensure performance is a function of stock selection, and we aim to avoid taking top-down macro bets, such as trying to predict what the interest rates will be like, or what the Fed would do, or what would be the oil price, and so on and so forth. So the decisions are made from a bottom-up stock philosophy, and the performance should also come from a stock selection. Now, I'll spend a minute or two on each of these 4 pillars, starting with what we think is a very highly differentiated team here at White Oak. Now, you would have probably come across a few other PMS managers, but seldom will you see such a well-resourced team. Not only number of people, but the caliber or the experience of the individual on the team. So today, as we speak, we have a 25-member investment team. And even from day one, we've always had a very large investment team managing clients' money. Now, I won't go into everybody's bios in the interest of time, but kind of summarize what we believe are some of the difference, what makes a team unique or uniquely strong. Number one, it's a deep bench of seasoned investors. Many on the team have been investing in Indian equity markets for multiple decades, have seen different market cycles, starting from the dot-com bubble or the Harshad Mehta scam. So the team is familiar with Indian equities, have knows the Indian promoters, and understand Indian businesses. Second, global investing experience. Like I mentioned at the start of the call, that Prashant has global investing experience, having invested in developed markets as well as emerging markets. But other than team as well, like Manoj, Ramesh, Rishi, Neeraj, have also invested in markets outside India, which provides a unique pattern and capability on the team. I'll give an example. We were evaluating Dr. Path Labs, the diagnostic sector. Manoj Garg, who used to earlier be with Bank of America Merrill Lynch for joining us here at White Oak, had covered diagnostics when he was with Bank of America. He had looked at this sector in markets like Mexico and Turkey. Now, you would agree that these markets are similar to India, but probably 15, 20 years ahead of us in economic evolution. But having covered diagnostics there, he was able to draw insights which help assess businesses like Dr. Bartlab, like Metropolis, not so much in terms of what would be the next quarter's earnings or something, but to understand how would the entire industry or sector play out from a point of competition, consumption, etc. Or take example, life insurance. The oldest life in a company in India is listed only 4 or 5 years ago, whereas names like AI in Hong Kong are listed for 30, 40 years. So Prashant, who covered the insurance sector when he was managing global emerging markets, was able to draw his insights from covering those sectors into understanding some of the companies here. The third attribute is the team within team structure. So every stock or every sector that we cover is jointly looked at by 3 or 4 members of the team. So if we take an example of IT, Ramesh, Ayush, Vishwa, and Pratyush would jointly be responsible for covering that sector. This, we believe, removes any individual biasness that might be there and also provides different perspectives, which again helps in research and decision making. So, three key attributes: deep bench of senior investors, global investing experience, and a team within team structure, which are either unique or have equipped the team to generate the kind of performance we have been generating the last 4 years. And finally, to ensure there is alignment of interest with our and skin in the game with our investors, all the investment team members have to invest their equity investment in the same PMS as that of our investors. So none of us are allowed to buy any direct equity or any investor monies in any other equity mutual fund or equity product. The second pillar of the 4 pillars, so we've covered team. The second is the philosophy. The philosophy of the team is that outside returns are earned over time by investing in great businesses at attractive valuations. Very often, advisors and clients tell us this is what everybody else says. Why or how are you any different? The honest answer is we are not different. It's just that investing is a sensual profession. There is no silver bullet. The devil lies in detail, or how well are you able to execute this philosophy of first identifying great business, then having a logical framework to value and the patience to buy it at an attractive price. So two elements: great business and attractive value, and we're looking for the most powerful combination of the two. So what is a great business? A great business is one which has 3 attributes. Number one, that generates superior incremental capital. Second, scalability. And third, well managed in terms of execution and governance. And all these are born out of the fundamental value equation, where value of any company is nothing but the present value of its future cash flows. Now, to have cash flows, it is a prerequisite that your return should be above your cost of capital. So you must earn your cost of capital and earn return above that. What we focus on is incremental capital, forward looking. So a company might have great backward looking ROIC, but what the question we ask is, can the company generate superior ROIC going forward on incremental capital? And for this, you have to understand the industry competitive or how intense is the competition industry, and whether or not the company enjoys any advantages in that space. Second is scalability. This is all about the growth. Now, what we want to focus on is companies which can grow exponentially relative to the market or relative to the peer group. There are many companies and said which will grow exponentially, but many won't. Like for example, companies in print media or combustion in food chain, we believe will face certain challenges. And the thing is, the market would tend to typically discount it while are actually happening. So it's very important to focus on companies that are scalable, like private banks, which we really still have a long runway for growth. Now, when you have the first two, that is superior ROIC and scalability, then very important to have a management which will execute well and take advantage of that opportunity. If you remember the mid 90s, the Reserve Bank of India had given banking licenses to a bunch of private sector banks such as HDFC, ICICI, Bank of Rajasthan, and GTB. The first two have created lakhs and crores of wealth for shareholders, whereas the latter two either had to be bailed out or went bankrupt. The opportunity was the same for all four. It's just that the execution capability was far superior, or the first were very strong execution DNA. So we focus a lot on the management's execution and whether or not they have the correct management which can execute well and take advantage of the opportunity. And finally, governance. Now, this is usually the starting point for all our analysis, because if governance is not of adequate quality, then it's a great business, but only for the controlling shareholders. You and I, or our clients and us, will not receive a fair share. Now, when it comes to governance, we have a 360-degree approach where we go and not only meet with the companies we are evaluating, but would also spend time with competition, listed, unlisted. We would also kind of meet with vendors, suppliers, ex-employees, regulators, anyone whom we think can provide us certain insights which will help us assess the governance DNA of a company. So I can give an example. We were evaluating a company in the sanitary ware, and there is a place called Morbi near Ahmedabad where there are contract manufacturers. So we traveled there and met with the contract manufacturers to understand if there are any companies which have under invoicing or over invoicing, to kind of get some more insights into the governance DNAs of some of the listed players. Because we strongly believe that in a market like India, you can make a lot of money by buying great businesses, but you can also make a lot of money for our investors if you're able to avoid the poorly governed businesses. So far, we've been able to avoid the corporate governance landmines. Now, once you've identified a great business, then it's very important to buy it at a price which is at a discount to its intrinsic or fair value. Now, there is a school of thought which says a great business can be bought at any price. And yes, you may outperform the market, but what we remind ourselves is that if you are focused on valuation, you can add an extra few percent point of performance, which will make all the difference between a top 1% manager and somewhere in the middle of the pack. Now, when it comes to valuation, we don't look at the traditional PE multiples. Instead, what we focus on is what is the cash flow multiples and what is the cash flow multiple as derived from our proprietary OpCo-FinCo framework, which is on this slide. Now, I won't go too much detail in this, but kind of just give you an overview as to what is our framework to value companies or value businesses. And it is no rocket science, but very much based on the first principle of finance. What we're essentially trying to do is, let's say a company has an enterprise value of 10,000 crores. What we really want to understand is, out of the 10,000 crores, what is the value of the invested capital in that business and how much is being earned over and above the invested capital. Because as you would agree, the invested capital is fungible. What really matters, or what is the actual value in that, is how much is being earned above the capital in the business. So we use this framework to assess what is the value of the invested capital and what is the value of the amount being earned above the invested capital. So let's take an example of a tire manufacturer called Balkrishna Industries. Now, Balkrishna Industries, for some of you might be aware, some of you don't know, is a tire manufacturer focused on off-highway tires. It basically manufactures tires which goes into your bulldozers, JCBs, tractors, etc., etc. So we would split Balkrishna Industries in two parts: a Balkrishna FinCo and a Balkrishna OpCo. The Balkrishna FinCo is a financing company and the Balkrishna OpCo is the operating company. For our analysis, we will house all the fixed assets and working capital under the FinCo. So we would, we would plant, machine equipment, working capital, finished goods, inventory, etc. all would be assigned under the Balakrishna Finco. The revenue of the company would be assigned to the OPCO. Now, the OPCO would pay a cost to the Finco to use the assets of the for the purpose of his business. So it's a bit like you can either buy a car or lease a car. So this is like as if you lease the car, you're paying an EMI. So the OPCO has leased the assets to the from the Finco and pays the cost to the Finco to use the assets. And what is the cost? The cost is 11%. Why 11%? Because that is what we believe is the expected returns from the equity markets. So OPCO pays 11% to Finco to use the fixed assets and working capital and then pays taxes to the government. What is left after paying these costs and taxes is nothing but free cash flow. And because you've paid for the cost of capital, it's excess return on invested capital, free cash flow. So it's after paying for the cost of capital. And now you project this to future years and you discount them using DCF, you get the present value of the OPCO, which is nothing but the value of excess returns on invested capital. Because remember, all the assets is in the Finco and you've paid a cost to use the assets. So we not only say that we like businesses with high ROIC, we also quantify as to how much is this ROIC value. The left side or the Finco is nothing but the value of the invested capital in the business or the dump capital in the business. Because by design, what the Finco borrows is what it lends at. So it's a one-time book business. Growth is immaterial. And given that we use 11% discount rate to invert the equation 1 by 11, it's a 9 multiple cash flow business. So the IC or the Finco is just the value of the capital business. It's a very low multiple business, only a 9 multiple cash flow business. Whereas the OPCO can be 20, 30, 40, even 50 times cash flow, depending on the strength of the franchise, sustainability of cash flows, any R&D advantages, monopoly in certain product lines, etc., etc. So the first input into valuation is enterprise value is nothing but the value of the Finco or just the capital in the business plus the value of the OPCO. Now, let me take an example here as to how this has worked for us. We were evaluating Balakrishna Industries in 2018, and we looked at all the other tire companies. So in 2018, Balakrishna was trading at 22 times PE multiple, and Apollo Tires was trading at 7 or 8 times PE multiple. Everybody agreed that yes, Balakrishna is a great company, but look, Apollo is available at much cheaper valuation compared to Balakrishna PE matrix. But when we looked at from this framework, what we realized that for every 1 rupee that Balakrishna was investing in the business as Finco value, it is able to generate 4 to 5 rupees as OPCO value. The same 1 rupee invested in Apollo was only generating 0.25 or 25 paisa as OPCO value. So yes, Apollo was much cheaper, but on an OPCO Finco framework or OPCO Finco multiple, Balakrishna was far more attractive and Apollo hundreds of times because Balakrishna was able to generate far higher returns on incremental capital that it was investing in the business. And as we all know, Balakrishna has done very well over the last 3 or 4 years. To take a very layman's analogy, it's a bit like you have 2 pots of curd. By looking at the 2 pots from outside, you can never tell how much is the butter content and how much is the water content each of them. But अगर आप उसको buttermilk बना लेते हो and you make kind of separate the butter and the water in each pot, you will know how much is the butter content in each of those curds. So same for businesses, we're separating the water and the butter. Water is basically the fixed or the invested capital business and hence has a lower multiple. Butter is a valuable component that is being earned above the cost of capital and has a higher multiple. Higher the butter in a business, more attractive it is, then obviously you want to see whether or not it is attractive valued. And that is where the second equation comes in, where we ascertain from the first equation, what is the market implying the value of the OPCO to be today. And when you divide that by the ROIC cash flow of any given year, you get the price to ROIC multiple. So this is in brief, our valuation framework, which we focus on, where we try and understand how much is the value of the capital in the business, how much is being earned up over and above that, and then obviously like business which have high ROIC, and then see if they're available at a discounted intrinsic or fair value. We begin with a very large or broad net. Any company above 1,000 crore market cap will become part of our investment universe. There are 750, 800 such companies. Then we filter them for or screen them out for weak characteristics like poor corporate governance, or if they are not scalable, or don't have good strong management. And then finally arrive at 200, 300 great businesses and invest in the 50 to 60 most attractive ideas. As we speak today, the portfolio looks a bit like this. The top half is a sectoral mix. You'll see that it's well distributed across sectors. There is no top-down view. This is built from a bottom-up standpoint, but we always maintain a good balance in the portfolio. There is nothing in energy, nothing in utilities. Again, it's not that we have a top-down view on these sectors. It's just that we've never been able to find a great business which meets, or find a company which meets a great business definition from these two sectors, and hence have not been able to invest so far. But otherwise, it's well distributed across sectors. What you can expect is sectors where there are a large number of names to choose from, such as financial or consumer discretionary, would always have a slightly higher position. But there is no top-down view which dictates the way we build the portfolio. The bottom left-hand side would show you the split by market cap: 54% at this point in large caps, 31% in mid caps, and about 12% in small caps. What you can expect in the PMS portfolio is 50 to 60% to be in large caps, 35 to 50% to mid and small caps, plus minus 10%. Again, there is no view that we will have this much in large, this much in mid, this much in small, but this is an expectation that we give client, that half the portfolio will be large caps and the other half will be a mix of mid and small caps. Finally, the one last slide that I wanted to kind of spend time on is to discuss some of the names that has done well for us, and some of the mistakes we have made since we started 4 years ago. The left side are the top 10 contributors to performance, and I say performance to alpha, and the right side are the top 10 detractors, or the mistakes we've made. 2 or 3 key takeaways. You will see the contributors is well distributed. It's not that any one name is either contributed to or dug a big hole to the portfolio. In fact, the 10th largest contributor, Balkrishna Industries, is actually larger than the biggest detractor, Dishman Carbogen. Second, the contributors are many times the size of the detractors. So whenever we had gone right, we had a larger position, and when we made a mistake, we either exited early or had a smaller position. Third, it's well distributed. The contributors come from a variety of sectors, variety of market caps, variety of industries. Very little common with each other. So LTI is a IT company, Info Edge, Naukri.com, Naveen Pune Specialty Chemicals, Ipca Pharma, Dixon Electronics, VIP Luggage, and so on and so forth. And finally, if there was a character of the portfolio to be inferred by looking at these names, it would be in a biased opinion that these companies are either market leaders or gaining market share in the segments or subsegments that they operate in. It is possible that the segment operates in a very small segment, but they are a dominant player in that particular industry, that particular space. These companies have strong corporate governance, have good management, execute well, have scalable businesses, and will only buy and hold them as long as they are available at a discounted intrinsic or fair value. Now, many of them will show you an ending where is 0%. That is because we don't like these businesses, or they're still great businesses, but they're not as attractively valued because of valuation reasons. The price has gone up. The right side, the mistakes we've made, again, these are examples of where we've gone wrong. They could be either because of us overestimating the management's execution capability or underestimating the economic challenges. And when we realize we made a mistake, we kind of exited. So I've covered what I want to cover. Very quickly summarize before we open up for Q&A if there is any. 2 or 3 things. Number one, White Oak manages a fairly large amount of AUM, 45,000 crores of Indian equities, 75% of that from offshore FI investors, 25% from domestic investors. Second, the performance both at White Oak and earlier that Prashant has been top 1% on multi-cap space, close to 25% return since we started Vito versus BSE 515% for a 10% alpha. Third, it's very consistent performance. That's thanks to having a very balanced portfolio where the aim of the team is to generate out alpha in up and down markets. So at the end of a complete market cycle, the performance is very strong. The performance comes from stock selection and not from an allocation effect. Stock selection is regarded as skill-based and is repeatable, whereas allocation effect is more like a luck or chance, and where you can have lesser confidence of that repeating in the future. And finally, the team that we have at White Oak is one of the most well-resourced, who come with global business experience, and is a critical component of being able to identify, track, and invest companies, and which allows us to look at a very large universe of companies. Any company of 1,000 crore becomes part of this universe, and we tend to find ideas. So what happens, large cap names are very well covered both by the sell side and tend to be fairly valued, but where the real alpha can be generated if you're able to find companies within small cap space. But there the biggest challenge is a lot of corporate governance risk. So if you need to have a very strong and well-resourced deep team to be able to find great ideas to invest in. So I'll stop there and see if there are any questions on anything that I've said or anything else that you would like to know.
Thank you, Vivek. Thank you for giving us insights about the product as well as about the White Oak management and the investment philosophy. How do you guys manage in all? So as correctly I have understood about this particular product, as you mentioned that this is like focusing more on the stock up focus approach, or I would say bottom up approach, rather than selecting a sector and then picking up or choosing a stock within that particular sector. And on a market cap side, as you said, that largely 50 to 60% is into a large cap, and rest probably is in would be a combination of mid and small cap. And lastly, you said that investment basically the portfolio invests in the market leaders and or probably in a companies which are dominating in that particular sector. So this is the overall few points I could pick up from the presentation. It was just a short summary for our team members. So apart from this, anything I have missed out, Vivek?
No, I think very well captured, Ritu. You kind of summarized it really well. Obviously, the starting point, Ritu, for us is corporate governance. So we pay a lot of focus on that, because as you would agree, in the especially mid and small caps, there's quite a bit of corporate governance landmines. So you want to avoid those, and to that extent, the first filter we use governance. If the governance is even a little bit gray, we kind of pass that opportunity and look at other names. So that's how we start, but otherwise very well summarized, Ritu, is what we do.
So it means the universe, you just take it. So first filter you just put it would be the corporate governance, and then probably then all the quant methodology probably would be applied.
Absolutely. Yeah. So first so basically we cast a net wide. So any company with 1,000 crore market cap plus minus a little bit would become part of the investable universe. So at the start of each year, we will look at all the names in this 1,000 crore. Let's say there are 800-900 names today to choose from, and then you filter that out for weak characteristics such as corporate governance, etc. And then whatever is left, let's say 400-500 names, that becomes part of your investable universe. And then you go out and build those models that I spoke about, and then see if they're attractively valued, and you track those closely. Because what happens even in this business is you keep getting new information, which you keep updating your valuation models, and then invest as whenever it's available at discount to its intrinsic of fair value, plus where you believe, because the portfolio is dynamic. So what it means is the portfolio keeps changing. So today, let's say we've invested in InfoEdge now, and let's say InfoEdge is 2% of my portfolio with a 50% upside. Now, let's say the team finds another idea. This is as an example, let's say they say HDFC Life with 70% upside. So at this point of time, we might actually reduce our weight in InfoEdge and also include HDFC Life in the portfolio. So that, so we look at both relative as well as absolute upside in each of the stocks. It's a very dynamic process. It's not a static portfolio. The portfolio keeps changing, reflecting this philosophy of a great business at an attractive valuation.
So probably I can take it in that way. Probably you might like the company going forward as well, but due to the relative performance, you might reduce the exposure of that particular stock.
Absolutely, absolutely. And it has happened, Ritu. Like, for example, when we started off in Larsen & Toubro Infotech and Larsen & Toubro Tech Services, we had 5.6% position weight. Now, as the stocks rallied from 2017, 18, 19, 20, we kept reducing the weightage in those stocks because as the price went up, it became less and less, the combination of a great business and a revenue kept reducing or weakening. And finally, we exited out of Larsen & Toubro Infotech sometime last year, because then obviously there are more other ideas relatively more attractive.
Right. Vivek, can we see the new age kind of a companies like, yes, Info Edge and all, you said that. So what all the parameters, for selecting those kind of or like new IPOs comes in the market? So
So
we can see in this portfolio?
absolutely, in fact, so like we are also very very focused on any new listings, be it new age tech companies or be it like let's say Manyavar, which just listed on, I mean, or we just have the IPO. So you would track everything. So because it's an opportunity for us to invest, right? The team is large enough, so they would, now we would track it. We would try and understand the business. We would also try and value it. If we believe that yes, this is a great business and it merits an investment, we would go ahead and take an exposure. Now in the PMS, for regulatory reasons, we can't invest in the IPO, but after it lists, we can definitely look at it. Now, there are certain new age businesses like Nika we have invested in, but certain names like Paytm we've not invested in. So it's not that we will invest in every single company. If it makes sense, yes, we will definitely look at it. And we don't, because we focused, we look at new. So idea is, can the company generate cash flows in the future? Now, Prashant had invested in 2000. In 2001, he started his career. That time, names like Amazon and Google had listed. So he has some understanding of how businesses can generate cash further down, if not in the next few years. So we do like some businesses in the new age space, but obviously some we don't like. And we are quite cognizant to understand which are the leaders in that space and which might be able to generate cash flows in the future. But to answer question, we would look at all companies which come up for listing. In fact, in the part of portfolio was a company like Lakshmi Organic or Dodla Dairy, which were all recent listings which we have participated in.
Okay. Uh, if in the current market scenario we see the portfolio is, as you mentioned, that around 53% into a large cap at this point in time, and rest is a combination of small and mid cap. So, what do you believe, like in this market scenario where we are standing right now, this combination works well for the investors?
So, Ritu, again, ex ante, if you ask us, we believe that large, mid, and small over a reasonable long period would give similar returns. If you look at historically, also last 15 years, large, mid, and small would be 1+% of each other. You can have a Reliance Communication, a large cap company becoming a small cap at one point, or you can have a small company becoming large cap. What really matters is how is the business in its own sector segment. Now, I'll give you a couple of examples how we look at it. Now, there is a company called Fine Organics in the portfolio. It is a very small company. When we bought it, it basically manufactures chemical, which, if you look at a plastic bottle like this, I don't know if it's with like a Bisleri bottle here, when you open this cap of the bottle will open without any friction. So there is a chemical which lines that particular cap. That chemical is manufactured by Fine Organics. Now, it is a very small sector, very small industry, but it is a dominant player in that space. So it's a small cap name, but dominant player. So we really believe that company will do well. But there could be a large cap company, but could be the fifth or sixth or seventh largest in that space. And they would struggle to have strong or earn return above the cost of capital, like telecom industry. Right? We all know what happened when there was 7 or 8 players. So it depends on each company and where they are relative to in that particular segment that they operate in. Now, we believe that whether large cap 50%, mid caps is 30%, small cap 12% at this point is a good mix. Now, obviously, the risk management is done from a way of having a very balance in the portfolio. Like I said, Ritu, the biggest thing is how are the portfolio in down markets. So if I give you some numbers, at the time of COVID, just before COVID, the portfolio had out of the market. When markets fell in 2020, the portfolio fell by say 23-24%, market fell by 30%. But the recovery was also quicker than the market. And that's because we don't have any style. So we don't have only high beta names or very defensive names. It's a good mix of high beta and defensive names, which helps generate performance in both up and down markets. And there is one strategy which quite a few investors use of investing right now is this STP facility or STP option. So let's say somebody is investing 50 lakh rupees. They can decide instead of coming one shot, they can decide to do an STP. So what that means is they give us the entire 50 lakhs. We would park 45 lakhs in liquid and invest 5 lakhs in equity. And then every month or fortnight, every week, move 5 lakhs from liquid to equity. So I will stagger the investment in also. So they'll get some diversification from a market timing perspective. Now, if they can do it over 10 tranches, 20 tranches, or even 3 tranches, the choice is investors. And they have a flexible choose between fortnightly, weekly, or monthly as well. So that could help them diversify the entry point into the markets.
Okay. Vivek, I have got a request to explain your EPCO FINCO strategy in Hindi.
Sure.
So I think lot many participants, it will give them a.
तो जैसे हम एग्जांपल लेते हैं बालकृष्ण इंडस्ट्रीज का. अभी यहाँ पे क्या करते हैं हम लोग की कोई भी कंपनी अपना जो यूनिवर्स में है, हम लोग उसको देखते कि कंपनी का वैल्यू जो है, अगर मान लीजिए कंपनी का वैल्यू 10,000 करोड़ है, उसमें से कितना खाली कैपिटल है कंपनी का और कितना बन रहा है कैपिटल के ऊपर में. तो अगर मान लीजिए आपने चालू किया आज एक प्लांट मशीन, कोई फैक्ट्री चालू कर रहे हैं, आप उसमें 150 करोड़ डाल दिए. अभी 3-4 साल के बाद मान लीजिए 100 करोड़ डाला आपने फैक्ट्री और प्लांट में, और 3 साल बाद उसने खाली 2 करोड़ रुपए आपको रिटर्न छूटा, तो आपका इन्वेस्टमेंट खाली 2% रिटर्न, लेकिन आपका कैपिटल का कॉस्ट ही 10% होगा, क्या तो 10 करोड़ रुपए होगा. तो जब तक आप 10% नहीं कमा रहे हो, तब तक आपका एक्चुअली आर नॉट मेकिंग एनी मनी अबव योर कॉस्ट ऑफ कैपिटल. तो ये चीजें हम लोग देखते हैं कि सारे कंपनी अपने यूनिवर्स में है कि अगर वैल्यू कंपनी का 100 करोड़ की 5,000 करोड़ 10,000 करोड़ है, उसमें से कैपिटल कितना है और कितना पैसा कैपिटल के ऊपर बन रहा है. तो अगर हम बालकृष्ण इंडस्ट्री एग्जांपल ले, अभी बालकृष्ण इंडस्ट्रीज टायर कंपनी है, लेकिन बनाते हैं ऑफ हाईवे टायर्स. जो टायर्स लगती है आपका जैसे मान लीजिए जो बड़े बड़े ट्रैक्टर्स, बुलडोजर्स, जेसीबीज, जो कोल माइंस में काम करते हैं, उसका टायर्स बनाते हैं. तो हम बालकृष्ण एग्जांपल ले रहे थे, उसमें क्या करते हैं कि 2 भाग करते कंपनी का. एक भाग है फाइनेंस फिनको, जिसमें जितना भी कैपिटल है कंपनी का, जैसे प्लांट, मशीनरी, इक्विपमेंट, वर्किंग कैपिटल, फिनिश गुड्स, इन्वेंट्री, वो सारे को हम फिनको में डाल देंगे. और ऑपको जो दाहिने हाथ का ये फिगर में है, उसमें हम लोग क्या करेंगे, जितना भी रेवेन्यू कंपनी का वहां हम ऑपको को एलोकेट कर देंगे. अभी ऑपको से हम लोग फिनको को एक कॉस्ट पे करेंगे, दैट इज द कॉस्ट टू यूज द कैपिटल इन द बिजनेस. तो अगर मान लीजिए मैं एग्जांपल लूं, अगर आपको बताया कि आप एक कार खरीदे, आपके पास 2 ऑप्शन है. एक तो आप जाके पूरा पैसा अपफ्रंट दे दे, या तो दूसरा ऑप्शन आपके पास है कि आप बैंक से लोन लेके उसका ईएमआई भरिए और हर महीना आप उसको ब्याज दीजिए. सो सेकेंड वाला हम लोग करते हैं यहाँ पे कि ऑपको इज पेइंग अ कॉस्ट टू फिनको टू यूज द एसेट्स ऑफ द कंपनी. तो बिजनेस में जितना भी एसेट्स एंड वर्किंग कैपिटल लगता है, उसको यूज करने के लिए ऑपको एक खर्चा देता है फिनको को, विच इज नथिंग बट अ कॉस्ट टू यूज द कैपिटल. तो कैपिटल यूज करने के लिए आप एक कॉस्ट देते हो. अभी ये कॉस्ट क्या है? दिस कॉस्ट इज 11%. अभी 11% इसलिए है क्योंकि 11% इज द एक्सपेक्टेड रिटर्न्स फ्रॉम द मार्केट्स. तो हमें लगता है कि आगे जाके आपको 11% रिटर्न मिलेगा मार्केट से, तो इसलिए हम लोग ऑपको से 11% कॉस्ट देते फिनको को, प्लांट मशीनरी इक्विपमेंट वर्किंग कैपिटल यूज करने के लिए फ्रॉम द रेवेन्यूज। तो रेवेन्यू से आपको 11% पे करता है फिनको को आपका प्लांट मशीनरी इक्विपमेंट वर्किंग कैपिटल यूज करने के लिए। उसके बाद गवर्नमेंट को टैक्सेस भर देते हैं। जो बचता है वॉट एवर रेवेन्यू और कैश फ्लो इज लेफ्ट आफ्टर पेइंग दिस कॉस्ट एंड टैक्सेस इज नथिंग बट फ्री कैश फ्लो, एंड इट इज आफ्टर पेइंग फॉर द कॉस्ट ऑफ कैपिटल, क्योंकि सारे कैपिटल तो फिनको में है। तो इसलिए हम इसको बोलते हैं एक्सेस रिटर्न इन्वेस्टेड कैपिटल फ्री कैश फ्लो। तो कैश फ्लो विच इज आफ्टर पेइंग द कॉस्ट ऑफ द कैपिटल इटसेल्फ। अभी इसको आप अगले 1 2 3 4 5 6 साल को प्रोजेक्ट कर दीजिए यूजिंग वॉट एवर यू थिंक द बिजनेस गोइंग टू जेनरेट फ्रॉम अ कैश फ्लो स्टैंड पॉइंट। तो अगर आप अगला 1 2 3 4 साल प्रोजेक्ट कर दिए और फिर आप उसको डिस्काउंट कर देते हो यूजिंग डीसीएफ, आपको आज के तारीख का वैल्यू मिल जाएगा ऑप्को का, विच इज नथिंग बट द वैल्यू ऑफ एक्सेस रिटर्न ऑन इन्वेस्टेड कैपिटल। जो कैपिटल को ऊपर पैसा मिल रहा है दैट इज द वैल्यू ऑफ द ऑप्को, क्योंकि आपने पूरा कैपिटल डाल दिया फिनको में और वो कैपिटल इस्तेमाल करने के लिए आपने पेमेंट भी कर दिया। तो इट इज द वैल्यू ऑफ एक्सेस रिटर्न ऑन कैपिटल इज द वैल्यू ऑफ द ऑप्को। लेफ्ट साइड जो है जो फिनको है दैट इज नथिंग बट जस्ट द कैपिटल इन द बिजनेस, और देर इज नो ग्रोथ हियर बिकॉज जितना भी आप बोरो करोगे सेम रेट पर आप फिनको ऑप्को को दे दोगे। तो इट्स अ वन टाइम बुक बिजनेस, और अगर आप 1/11 करोगे यू विल गेट अ 9 मल्टीपल। तो फिनको का वैल्यू खाली 9 मल्टीपल कैश फ्लो है, विच इज अ वेरी लो मल्टीपल बिजनेस, बहुत कम मल्टीपल का बिजनेस है, क्योंकि इट इज नथिंग बट द जस्ट द कॉस्ट ऑफ कैपिटल। एंड कैपिटल फंजिबल है, आप डाल सकते हो प्लांट में, या तो कोई इक्विटी मार्केट में, या तो कोई फिक्स डिपॉजिट में, तो किसी को आप लेंड कर दो। देयर इज द कैपिटल इज फंजिबल, सो इट इज वेरी वेरी लो मल्टीपल बिजनेस। लेकिन जो ऑप्को है दैट कैन बी 20 30 40 इवन 50 टाइम्स मल्टीपल, डिपेंडिंग ऑन कितना स्ट्रॉन्ग है आपका फ्रेंचाइज। अभी मान लीजिए नेस्ले पकड़ एक कंपनी है, उसका मोनोपोली है इन बेबी फूड्स, सो इट कैन डिमांड अ वेरी हाई मल्टीपल। और लेट्स से अगर आपके पास मैनेजमेंट बहुत सही है जहां पे एग्जीक्यूशन कैपेबिलिटी बहुत स्ट्रांग है, दैट विल आल्सो डिटरमिन कितना आपको मल्टीपल मिलेगा, या तो कितना कैश फ्लो बन सकता है। जैसे नवीन फ्लोरिन अगर कंपनी ले केमिकल्स, पहले केमिकल, इट इज बाय फार द डोमिनेंट प्लेयर इन फ्लोरिन केमिस्ट्री, and fluorine chemistry is a fairly complicated chemistry where there are very difficult to enter for a new player. तो अगर उसमें मैनेजमेंट का एग्जीक्यूटिव अच्छा रहा, स्केलेबिलिटी है, दे हैव गुड R&D, then you can generate superior cash flows going forward. So all these factors would determine कि कितना मल्टी मिलना चाहिए ऑप्को को। कभी कोई 20 मिल सकता है, 30 40 50। तो अभी जब हम देखते कोई कंपनी का वैल्यू, हम देखते क्या कि एंटरप्राइज वैल्यू जो है, वैल्यू फॉर कंपनी इज नथिंग बट जो मेरा फिनको है, जो मेरा कैपिटल है, दैट प्लस द वैल्यू ऑफ द ऑप्को, कि मैंने कितना पैसा कमा रहा हूं मेरा कैपिटल के ऊपर। तो ये दो एक साथ करेंगे तो मेरे को एंटरप्राइज वैल्यू आता है। नाउ व्हाई इज दिस इंपॉर्टेंट? क्योंकि अगर पी मल्टीपल देखते हैं, पी मल्टीपल डज नॉट सेपरेट द कैपिटल फ्रॉम द एक्सेस बीइंग अर्न्ड अबव द कैपिटल, वो एट अ टॉप लेवल पे एक मल्टीपल दे देता है। नाउ आई विल गिव यू एन एग्जांपल। या अगर आपको इफ यू नो दिस कंपनी कॉल वरुण बेवरेजेस, अभी पेप्सी का दे मैन्युफैक्चर, दे बेसिकली बॉटलिंग करते हैं। तो बहुत बार बोलते हैं कि देखो पेप्सी का यू कैन नॉट बाय पेप्सी इन इंडिया, पर वरुण बेवरेजेस पार्टिसिपेट कर लो, क्योंकि अगर पेप्सी का सेल होगा तो वरुण बेवरेज फायदा होगा, बिकॉज वरुण बेवरेज उसका बॉटल करता है। बट अगर आप वरुण बेवरेजेस का पी मल्टीपल देखेंगे बहुत कम है, करीबन 20 30 टाइम का पी मल्टीपल होगा, whereas other FMCG name like Nestle और HUL will be much higher। बट अगर इस मॉडल पे देखोगे आप कि उसमें आपको अगर मान लीजिए वरुण बेवरेज का एंटरप्राइज 10,000 करोड़ है, उसमें से आपका 50 to 60%, करीबन 50 से 60% खाली फिनको वैल्यू है, मतलब उसका कैपिटल का वैल्यू है, एंड खाली 30 से 40% आपको ऑप्को से आ रहा है। तो it is a low PE multiple, but that is because it is not able to generate returns above its cost of capital, और उतना सारे रिटर्न नहीं बन रहा है जितना जिसके you want to give a higher multiple to। So इससे क्या होता है, we are able to identify businesses एंड अंडरस्टैंड कि एवरी बिजनेस को हम ऐसे देखेंगे तो वी कैन मेक आउट कि एक तो कंपनी कितना वैल्यू है, उसमें से कितना खाली कैपिटल है, एंड हाउ मच इज अबव द कॉस्ट ऑफ कैपिटल। जितना ज्यादा आपको वैल्यू है, दैट मच मोर वैल्यूबल द कंपनी इज टू अस फ्रॉम एन इन्वेस्टिंग स्टैंड पॉइंट। एंड देन अगर आप उसको देखोगे कि मार्केट कितना वैल्यू दे रहे हो कंपनी का, एंड देन यू नो डू द मल्टीपल, दैट इज नथिंग बट आपका मान लीजिए मार्केट कंपनी का वैल्यू दे रहे हैं कोई कोई साल में 10,000 करोड़ में से 8,000 करोड़ आपको वैल्यू दे रहे हैं, उसको अगर उस साल का लेट से आप डिवाइड कर दो, उस साल का कैश फ्लो मान लीजिए 800 करोड़ है, तो 8/800 तो 10। सो नाउ यू नो द मार्केट इज गिविंग अ फेयर वैल्यू, सो देन इट इज अ फेयर वैल्यू प्रोडक्ट। पर अगर मार्केट उसको ज्यादा दे रहे कम दे रहे, देन दैट बिकम्स एन अपॉर्चुनिटी हम लोग के लिए टू बाय और नॉट बाय। तो दैट इज द सेकेंड इक्वेशन, जहां पे हम देखते हैं कि मार्केट क्या वैल्यू देते हैं, बेस्ड ऑन दैट हम लोग उसको इन्वेस्ट करते या तो नहीं करते। तो मतलब हम ये कहना चाह रहे हैं कि सारे कंपनी को हम लोग दो या तो स्प्लिट कर देते हैं, पहले निकालते हैं कि कैपिटल कितना कंपनी का, उसका एक वैल्यू दे दीजिए विच इज अ लो मल्टीपल, एंड कितना पैसा बन रहा है अबव द कॉस्ट ऑफ कैपिटल, उसका अलग से वैल्यू कीजिए, एंड उसका मल्टीपल ज्यादा होगा डिपेंडिंग ऑन द फ्यू फैक्टर्स दैट आई मेंशन। अगर आप ऐसे कर देंगे तो यू कैन ओनली फोकस ऑन द ऑप्को एंड कंपेयर कंपनीज both within the sector as well as across sectors. I hope I was able to explain.
Yes,
Vivek,
yes, Vivek.
हाँ,
At least
no,
for me, thought
no, आई एम सेइंग विवेक ने पूरा एक्सप्लेन कर दिया, बट अगर थोड़ा मारवाड़ी तरीके से, आई मीन बनिया तरीके से समझाएं प्रोबेबली, तो जस्ट गिव मी 2 minutes, आई एक्चुअली आपको फिनको अगर ऋतु तुम देखो ना, इट्स मोर ऑफ अ बनिया बुद्धि हमने लगाया है इसके अंदर कि फॉर एग्जांपल लेट्स से देयर आर 2 पीपल, लेट्स से ऋतु आपका एक बिजनेस है, मेरा एक बिजनेस है, राइट? आपको 1 करोड़ का रेवेन्यू मिलता है, मुझे भी 1 करोड़ का रेवेन्यू मिलता है। आपके केस में इट्स यू हैव टेकन कैपिटल फ्रॉम द मार्केट, राइट? वो सब कैपिटल आपने लिया, इंटरेस्ट पे किया, फिर आपका 1 करोड़ बना है। मेरे केस में लेट्स से आई हैव एंसेस्ट्रल प्रॉपर्टी, मुझको कुछ खर्चा नहीं देने का है, पर मैंने भी 1 करोड़ बनाया। यू हैव मेड 1 करोड़, आई हैव आल्सो मेड 1 करोड़। नाउ whose 1 crore is more valuable?
of course yours.
I'll ask you, right? जिसने नहीं आपका होगा, बिकॉज आपने कॉस्ट ऑफ डेट भी पे किया है,
राइट राइट,
सब कुछ खर्चा पे करने के बाद आपने 1 करोड़ बनाया है। मैंने तो एंसेस्टर लिया,
आफ्टर पेइंग आई हैव
you have paid, right? You have made 1 crore after paying cost of debt also. Let's say you are a 60-40 structure, आपने 60 लाख रुपया मार्केट से लोन लिया था, उस पे आपने 11% इंटरेस्ट दिया, देने के बाद आपने 1 करोड़ बनाया है। मेरा तो एंसेस्ट्रल है, मुझे पैसा देना नहीं पड़ा, तब भी मैंने 1 करोड़ बनाया है। वैल्यूएबल इज योर्स बिकॉज यू हैव डिडक्टेड द कॉस्ट ऑफ कैपिटल, राइट? So that's what we are trying to say in this framework कि इंडिया में जितनी भी कंपनीज हैं, अभी जब हम प्राइस अर्निंग मल्टीपल लगाते हैं या प्राइस टू बुक वैल्यू लगाते हैं, अब अर्निंग मल्टीपल में तो पता नहीं लगता ना कि कैपिटल स्ट्रक्चर क्या है, डेट कितना है, इक्विटी कितना, वो आपको पी नहीं बता सकता है, करेक्ट? सो व्हाट वी आर ट्राइंग टू डू, हम यहां से उसका कॉस्ट ऑफ कैपिटल निकाल देते हैं, राइट? तो जैसे आपने जो बिजनेस लगाया है या मैंने जो लगाया है, जो एंसेस्ट्रल है, चाहे वो एंसेस्ट्रल है, अगर वो पैसा कहीं और लगाता 10% तो मेरा छूट जाता, जो अपन बोलते हैं ना कि ब्याज नहीं छूट रहा है, उतना ब्याज तो मुझे मिल जाता, राइट? तो मैंने वो ब्याज का कंपोनेंट अलग निकाल दिया, मैंने इंटरेस्ट कंपोनेंट निकाल दिया। उसको निकालने के बाद मेरा पैसा कितना बचा है, दैट इज बेसिकली व्हाट ऑप्को इज ट्राइंग टू डू।
सो बेसिकली आपने जितना भी प्रॉफिट कमाया है, उसमें से आपने जितना भी अगर आपने इफ यू हैव टेकन सर्टेन लोन एंड ऑल, यू हैव रीपेड दैट, आफ्टर दैट व्हाट यू आर अर्निंग, बेसिकली दैट यू आर जस्ट कंपेयरिंग।
एब्सोल्यूट। सो वी आर कंपेयरिंग बिजनेसेस जहां पे अगर मैं ऑपरेटिंग लीज दे रहा हूं या कैपिटल फाइनेंसिंग चार्ज दे रहा हूं, बेसिकली टू यूज दी प्लांट मशीनरी इक्विपमेंट वर्किंग कैपिटल, उसको मैं यूज कर रहा हूं, उसका मैं खर्चा माइनस कर रहा हूं, उस खर्चे को माइनस करने के बाद मेरे पास कितना बचता है। तो जो विवेक एग्जांपल दे रहे थे, फॉर एग्जांपल अपोलो टायर एंड बीकेटी का, अपोलो टायर का ऑलमोस्ट 90-95% एज यू सेड उसी में चला जाता है, राइट? कॉस्ट ऑफ कैपिटल सर्व करने में, जबकि बीकेटी का बहुत कम जाता है। तो वो जो बैलेंस बचता है उसकी ऑपरेशनल एफिशिएंसी बढ़ जाती है, क्योंकि वो 25 रुपए ही दे रहा 100 में से कॉस्ट ऑफ कैपिटल में, बाकी उसका पैसा जो है वो ऑपरेशनल एफिशिएंसी को बढ़ा रहा है। Am I right, विवेक?
एकदम एब्सोल्युटली करेक्ट नितिन।
वो थोड़ा सा ये ऑप्को फिनको, क्योंकि खेमकर साहब भी तो थोड़ा मारवाड़ी, ये मारवाड़ी टच है हमारा, यही रहता है कि बहुत खर्चा निकल रहा है नहीं निकल रहा, पहले वो एनालाइज करो।
एक्चुअली नितिन जो आपने बोला सही है कि कोई भी बिजनेसमैन जब बिजनेस चालू करते हैं कोई तो कैपिटल लगाता है। अभी बिजनेस का फायदा तभी होगा जब उनका कैपिटल का खर्चा निकल जाता है। तो एंड ये प्रशांत ने चालू किया था जब कॉलेज में थे, क्योंकि उनके पास एक स्टोर था कपड़े का इन अंधेरी। तो उनका तो बहुत पुराना स्टोर था, बाजू में अनदर पर्सन टुक अ स्टोर एंड चालू कर दिया। तो तब उनको दिमाग में क्या लगा कि फॉर हिज नेबर ही कैन ओनली मेक मनी वंस ही रिकवर द कॉस्ट ऑफ द स्टोर। अभी स्टोर में मान लीजिए 2 करोड़ रुपए लग गया खरीदने को स्टोर, अभी 2 करोड़ का तब का दिन का ब्याज था करीब 15-16%। तो जब तक 30 लाख रुपए नहीं कमाते, ही इज नॉट एबल टू रिकवर द कॉस्ट ऑफ दैट स्टोर, तब तक दैट बिजनेस नॉट जनरेटिंग एनी इकोनॉमिक वैल्यू। तो सेम फॉर एनी बिजनेस, पहले आप कैपिटल का तो पैसा निकाल लो, उसके बाद जो बनता है दैट इज योर वैल्यूएबल मनी, एंड वो जितना है उतना वैल्यूएबल कंपनी बनती जाएगी। सौरभ जी, I was able to explain. Okay, thank you.
So I think he has given his remarks. So nicely explained, Nitin, because with a very ease you explained, to our team, because some of them, understand the Marwari language very well. So, so participants, any other questions related to the product or, related to Y2? So I would request, if you have, you can put it on chat box. Else, at last, I would just request Vivek, if you can highlight 5 pointers about your Pioneer product, you can, tell our team. So, with that, we can close today's session.
Yeah, sure, Ritu. So I think 5 pointers में तो पहले and foremost की at the end of the client को return ही चाहिए होता है, right? And what I can say कि प्रशांत has been investing in Indian equity markets for करीबन अभी 2007 से, तो almost 15 साल होने को आ रहा है। अगर उनका ट्रैक रिकॉर्ड आप देखोगे 15 साल में, it is 20% रिटर्न्स annualized in an period जब मार्केट ने दिया है करीबन 10%। So 10% से अल्फा जनरेट हुआ है। If you look at this such a long period, it is by far one of the best performing funds in the multi cap space. तो अपना एम है कि मार्केट से 10-11% रिटर्न आएगा एंड द अल्फा द टीम विल जनरेट इज 7-8%। तो करीबन 15 से 20% का रिटर्न आने का चांस इज व्हाट वी एक्सपेक्ट गोइंग फॉरवर्ड द पोर्टफोलियो टू जनरेट ओवर 4 to 5 to 6 years टाइम फ्रेम। दूसरा पॉइंट ये है कि एक तो रिटर्न्स का नंबर, बट इंपॉर्टेंट, वेरी इंपॉर्टेंट इज कंसिस्टेंसी। बिकॉज अगर आपका रिटर्न्स कंसिस्टेंट है तो एज एन इन्वेस्टर यू आर far more confident that the performance will repeat, and the only way to have consistent performance is to have a very good balance in the portfolio. तो अपना बैलेंस पोर्टफोलियो अप्रोच जो है उसमें दो चीज हो जाता है, एक तो आपका रिटर्न्स कंसिस्टेंट हो जाता है, देयर इज ऑटोमेटिक रिस्क मिटिगेशन, क्योंकि वो ऑलवेज हैव अ गुड मिक्स। अभी मान लीजिए 2020 का कोविड के टाइम पे अगर हम ऐसे व्यू ले लेते, कभी मार्केट बहुत बेरिश लग रहा है और पूरा हम चले जाते इन डिफेंसिव है तो कैश बढ़ा लेते, एज यू नो मार्केट ने बहुत फास्ट रिकवरी कर दी, तो वी वुड हैव अंडर परफॉर्म द मार्केट। तो अभी हम कभी कैश कॉल नहीं लेंगे, ऑलवेज हैव बैलेंस इन द पोर्टफोलियो, गुड मिक्स ऑफ सिक्योरिटी। तीसरा पॉइंट है कि इट्स अ मल्टी कैप स्ट्रेटेजी, अपना ऐसे कोई रेस्ट्रिक्शन नहीं है, वी कैन इन्वेस्ट इन लार्ज मिड स्मॉल अक्रॉस सेक्टर्स, जहां पे हमको आइडिया लगे कि दैट पर्टिकुलर स्टॉक विल बी एबल जनरेट परफॉर्मेंस, we would go and invest, but we have very strong focus on corporate governance. And fourth point is the team size. Abhi there is lot of technology available, there's a lot of softwares available to analyze companies, but जब तक आप खुद जाके रिसर्च नहीं करते हो तो तब तक you are not able to get comfort. So the caliber of the team, अभी जैसे मनोज गर्ग है, लास्ट ऑलमोस्ट 25 ईयर एक्सपीरियंस है, पर उनका पहला 10 साल एक्सपीरियंस है फार्मा कंपनीज में, ही वाज वर्किंग विद सिप्ला निपका, उसके बाद ही स्टार्टेड इन्वेस्टिंग, नाउ ही नोज द फार्मा सेक्टर इन एंड आउट। So that kind of caliber is very helpful when analyzing companies, both current company as well as जो future में list होंगे. The team size makes a big difference. And finally, we have a good strong base of investors. करीबन 45,000 crore रुपए we manage, and that is on the back of the strong track record that we spoke about. So that is what I will say. कि अभी Pioneer's portfolio can be looked at as a core portfolio. It's a well diversified portfolio, but with very high alpha generating potential. तो 40 से 50 या तो करीबन 55 स्टॉक रहेंगे पोर्टफोलियो में, बट द ट्रैक रिकॉर्ड इज शोन इट कैन गिव 8-9% alpha. So if you think about it from a diversity perspective, it's well diversified, but from a alpha perspective, it can generate high alpha.
Yeah, very nice point. You said that this particular strategy you can look at as a part of your core allocation. So though it's a multi-cap portfolio and it's a well diversified across stocks, and with the bottom-up approach is there, so it's not like you are getting a concentrated bet you are taking on particular sector. So it's a well pick and choose kind of a strategy. Client can get it, and as you said that we have seen a good alpha, and we are just hoping that going forward that alpha would remain same. So I would request team to please look into this particular product, and I think very well explained by Nitin the strategy also of the fund, how they bifurcate the stocks and evaluate the stocks basically. So on that note, I would say thank you Vivek and Nitin. Thank you for giving us an insight on the product, and I would request team to participate in this particular product. Thank you, participants.
Thank you, everybody.
Thank you so much, Ritu.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.